Bloomberg Audio Studios. Podcasts, radio, news.
Let's get back to Friday's blowout payrolls report, reshaping Fed expectations for the rest of the year. Torsten Slok of Apollo saying there's no need for cuts. Quote, the Fed is cutting rates, which is boosting growth and inflation further. Combined with very easy financial fiscal conditions, the bottom line remains that rates will stay higher for longer. Torsten Slok joins us now for more. Torsten, good morning.
Morning.
You caught your breath after the victory lap around a studio table. It's good to see you, sir. How did you feel on Friday when that number dropped?
Well, I think it makes sense what's going on. I mean, as you just talked about, it's not clear that the data has been slowing down. GDP last quarter was around 3. The Atlanta Fed GDP now for this quarter is around 3. And if you take this combined with, broadly speaking, strong data on consumer, on durable goods, it makes sense that the labor market is also still hot. It never made sense to say, oh, the economy is good, but the labor market is bad. You can't have it both ways. Either it's good in the economy and good in the labor market. You can't have that the economy is good and the labor market is bad. That just never made sense. So that's why, given the economic data coming in, the totality of the data, as Jay Powell would say, I still think that it's very obvious that things are still chugging along.
Well, let's sit on the totality of the data. So the survey data last week, the ISM's, employment components, not fantastic.
Well, the service headline was still good.
Well, we can get into that in a moment. The jolts as well. If you look at the jolts, job openings were up, but hiring was down, the quits rate was down. If things were great, you'd expect the quits rate to still be elevated. You'd expect hiring to be elevated too. Some people have pointed out that maybe this is inconsistent with the broader data. What do you say back to them?
Well, I think that what's going on in the JOLTS survey is really a normalization. Because in the JOLTS survey, what you also have that the layoff rate is still one. The layoff rate has not gone up, meaning it's not the case that companies are firing workers. You're on the other hand just seeing a little bit less hiring. So that's just a normalization and combined, of course, with still steady immigration and at the same time tailwinds from defense spending, from AI, from energy transition, and consumers that are not very sensitive to interest rates going up because of locked-in low interest rates. We still have some fairly strong tailwinds to the outlook and less sensitivity to what rates are doing. So therefore, it still makes sense to believe that over the next several quarters, the economy will do just fine.
Well, it's that sort of thing that's allowed a lot of critics to look at this decision in light of the jobs data and say it was a mistake to go 50. But Torsten, is there a world where this jobs report wouldn't have looked as strong if they didn't go 50, that it helped maintain strength in the labor market and reinvigorate confidence?
Well, the key issue, of course, as usual, is what are the long and variable lags? The Fed textbook would say that's 12 to 18 months before anything starts to show up. But as we know very well, the stock market is now becoming a very important indicator for companies in terms of, are we doing well, are we not doing well, should we hire, should we not hire? And given the significant tailwind to risky assets, credit spreads are very tight, both on IG, high yield and loans, and also when it comes to the equities going up. All that made actually exactly imply that we have had faster transmission of monetary policy because the signaling, the forward guidance has been coming through much quicker than what the textbook would have predicted.
Does that suggest then 50 was a mistake?
Well, Jay Powell said at the press conference 10 times that they did this to recalibrate monetary policy. So there was a lot of this time, of course, a discussion, as of course also you guys had a lot of here about why did they do this? What's recalibration as an excuse? And of course the excuse was inflation has now come down. But given that the economic data is still strong, it really is Goldilocks with inflation back close to 2%, and the economic data just continues to power along. So that's why the Fed is now stuck at a situation where they need to say, well, should we look at the economic data, or as you just said before, Danny, or should we turn to inflation and say maybe inflation is a risk of moving up again?
But when you look at the totality of data, and Jonathan pointed out that some of these actually are going in the wrong direction, besides this one unemployment point that was a blowout. Do you think the Fed will err on the side of cutting too much rather than cutting too little?
Well, the Fed has definitely had a tendency that the risk to the unemployment rate for the last 5 years has always been, in their view, that it would go higher. So that's why a very important discussion on that is, of course, well, where do they put the emphasis? Do they put the emphasis now on that it's not really only the JOLTS data that's weak, and it's also a number of other indicators that have shown slight weakness when it comes to some specific small areas, but the vast majority of the data that comes in, consumers, in the daily data, you're still seeing restaurant data being very good, TSA data for travel still very good. You also have the debit card data from my Bloomberg screen, and spending on the daily data is also very good. So you have across the board a lot of indicators that still continue to be really moving along quite nicely. There is just no slowdown. It's very clear that the JOLTS data stands out on its own as a very special story.
So November 7th, what do you think the Fed should do, and what do you think they will do?
Well, the problem for them now is that they have pre-committed themselves too much to R* and to rates going lower. So that's why I do think that they will cut 25 basis points. But the key issue here is that all the incoming data being so strong, is telling us that maybe our star is not 3%, which is where the Fed is saying it is at the moment. Maybe it is more like 4.5%, which we do in our own Kalman filters of estimating where it should be. So that's why we think that we are not too far away from the monetary policy stance currently being close to neutral. So if that's the case, we don't need a dramatic amount of Fed cuts, which has been even also put into the dot plot by the FOMC members themselves.
You sound vindicated. Do you think Governor Bowman is as well on the FOMC? Has she got any company?
Well, she was the lone dissent, of course, saying, well, we should not have cut 50. Well, I do think that we'll get a lot of Fed speeches today, including Alberto Mussolem here at New York speaking, of course. So, but all that ends up, in my view, being very, very important for us to see, are they backpedaling now? Are they backtracking from this? Oh, we need a lot of cuts. Well, maybe we don't need a lot of cuts because the incoming data continues to just be strong.
They say they're not in a rush. Do you believe them?
I do believe them because think about what creates recessions. In 2020, the recession was caused by COVID. Of course, that generated a recession. Lehman Brothers, of course, that generated a recession. Prior recession, S&P 500 went down 50%. That generated a shallow recession. And prior to that, we had the commercial real estate crisis and the savings and loan crisis in the 1990s. Of course, that generated a recession. But where is the shock today? Where is the shock that should generate a recession? The only shock is we've had the Fed raising rates, but that's been countered by now AI spending, defense spending, fiscal spending. So that's why monetary policy has not been as restrictive as our textbook would have been saying. So that's why our textbook, we should probably put that more aside. And that's probably still a good recommendation for the Fed. Let's put this textbook aside and look at the incoming data, and the incoming data continue to actually be strong.
So if the neutral rate isn't as low, if monetary policy transmission when they're cutting is happening at a quicker speed, what will be the implication of them continuing to cut into strength?
Well, the challenge is that we still have the tailwinds from very strong spending from the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. We also have very strong tailwinds from AI spending. I mean, no one you meet says, oh, I'm not going to invest in AI because the Fed has just raised interest rates 25 basis points. Everyone still wants to invest in AI. And energy transition, we also have that as a strong tailwind. And finally, also deglobalization, the industrial renaissance, the construction of manufacturing plants in the US is also a strong tailwind. Those are things that the Fed can't really control because these are the stories that we talk about in markets at the moment. So in that sense, monetary policy is just unusually weak in terms of having a negative impact when rates went up on the economy.
Torsten, does the market still also have the tailwind of the Fed's first pivot of December 2023?
Absolutely, because in December, as we all remember, they clearly said now rates are going down. And before that, there was very little activity in IPO, in IG issuance, high yield issuance, loan markets. Everything was relatively weak and, broadly speaking, at a standstill. After the December pivot, they really have seen a significant opening of financing markets in all directions. And that's also exactly as you're saying, Annmarie, provided a very strong tailwind in easy financial conditions. And therefore now, if you are a company that want to do something in private credit, in private equity, a lot of more things are just possible relative to what we had earlier.
Torsten, it's good to see you. Wonderful to catch up. Congratulations. So far, so good after Friday. Torsten Slok of Apollo.